Okay, so the last 2 weeks we've started this show with the intro with jokes. So I think we need to keep with the joke theme. I'll make you a deal. If you ask me at the end of the show, I'll give my best joke if you guys do the same thing in future episodes. Deal?
Is it a good joke or is it?
Does it have to be clean?
It's a good joke. It's not a clean joke, so we're gonna have to give a warning or a disclaimer.
So it's not just like a dumb dad joke that you tell all the time.
No, this is my favorite joke of all time.
Okay.
Oh, okay. All right.
Okay. All right.
You guys-
Yeah, I'm interested.
Okay, I'll do it this week at the end of the show. If you guys do it,
I'm interested to see how lame your I'm interested to see how lame your joke is. But yeah, let's do it.
Yeah, high expectations now.
okay. End of the episode. You have to remind me.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 40 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson, husband. Episode 40, AJ, we're both turning 40 this year, aren't we?
That's right.
This is like a milestone for all of us. I'm excited. How's it going over there, AJ?
It's going good. You know what? Start out with the 40-year-olds, right? Or we're still in our 30s. Hold on. We got to hold on while we can. We're still in our 30s.
No, first of all, you're not. You're already been in your 40s. You started your 40th year of life. Your last birthday. You've passed 39, but you've been on the 40th for the last year. So now you're going to hit 40, and you're going to start 41st year. So don't get too excited, guys.
Mr. Graybush over there is so bitter, huh?
It's not how this works.
Mauricio coming in with the complicated math here.
It's a common core. Is it called common core math? Whatever.
Oh God, don't get me started with that new math the kids are doing. Your kids get that too, the new math? Oh geez. Show your work on everything. What are you drinking over there, AJ?
I've got
Wait. We're starting with AJ? Wait, how come we're starting with AJ?
Because he's turning 40 this year and it's episode 40.
Come on. Try to keep up, Mauricio. Try to keep up.
Episode 65, Mauricio, you go first.
That's right.
Still a red solo, eh, AJ?
That's right. Fountain Diet Coke, the best.
AJ, I'm going to send you a bottle. I'm going to send you a nice bottle of bourbon for your birthday.
My staff will appreciate that.
I'll fly in to get it. Who should I do next? Let's go with Jay. Jay, how's it going over there, man?
I'm doing well. How are you doing?
Great.
Youngest to oldest.
Am I the oldest or is Mauricio? I think Mauricio has me beat by a year.
That's why Mauricio's going after you. It's youngest to oldest.
I definitely the one that has the most white hair. I know that. I mean, you guys don't even have one.
I'm catching up.
They're sneaking in my beard. What are you drinking this week, Jay? Or you got some little fruity?
I drink every week. So last week I did the coffee, which was great because it actually kept me up with you guys, boring the hell out of me. So I'm doing the coffee again this week, and this week in it I am putting the Costco Irish cream liqueur. So back to my Costco roots.
This is so boring, Jay. You're just a boring drinker. Mauricio, at least Mauricio comes through with some interesting drinks to help the audience.
Yeah, so I'm doing this is a first. We've been doing 40 episodes, and I have not. But I don't think I'm. Look, if somebody thinks I'm wrong, drop a comment. But I don't think I've had a champagne on the show. But this is one of my favorite. Let's call it day-to-day champagne. It's nothing too crazy, but the Stromberg Blanc de Blanc is one of my favorite little bubbles, and got my fancy little glass right here, and really looking forward to enjoying a little. Actually, champagne. It's actually champagne, not spark. Don't confuse champagne with sparkling wine.
I actually picked up a bottle of that from Costco last week.
Mauricio, you're channeling your partner Bethany a little bit. Isn't that what she does? The bubbles with Bethany?
That's right. Bethany's a big champagne. She's got a show called Bubbles with Bethany, which I think is a fantastic name. And it's funny. Bethany and I hung out about 3 weeks ago, and she was on like dry February or something, and she was sworn not to drink all of February, and then she spent 5 minutes with me, and we just boozed it up and drank champagne all day. I'm a bad influence.
Speaking of dropping comments, I think I see we are almost at 1,000, right? So
966
subscribers.
Let's try and get this like and subscribe. If you guys are getting any value of what we do, we don't take any money or anything from this. No advertisements yet, other than Mauricio's book. So just get a little subscribe there and just help us out, hit 1,000 so that we could celebrate that.
As my kids would say, smash that subscribe button.
Smash that subscribe button so that you can have more access to getting my book and more opportunities to get my book.
Or you can be like Jerome Powell and push it dovishly. All right, since you guys aren't asking me, I am drinking.
Oh, wait, before you do that, Kyle, what are you drinking?
I went back with the Angels Envy I got for Christmas last year. This is actually only my second time popping. It's pretty good, but I'm pretty good mood. I'm going on vacation tomorrow, so sneaking this in.
Isn't your life a vacation?
Well, yeah. When you spend this much time with Ashley Wilson, life is just always a vacation. If only she listened to this, I would get brownie points for that, but she never listens. All right, should we talk about Powell a little bit then to start this off? Because we had a Fed meeting last week, and as expected, there was no rate hike. But people are a little surprised by the dovish tone and the fact that the Fed is still predicting 3 cuts this year. We also had some other economic news with the Case-Shiller hitting highest mark in history, GDP outlook revised up, and productivity is through the roof. So, Jay, does the Fed have everything under control here?
So I have a theory. And I know I'm going to take.
Oh boy, here we go.
I'm going to take a lot of flack for this in the comments because anytime I defend the Fed, I take a lot of flack in the comments. But I'm going to defend the.
Wait, does it have to do with immigration? Because that's my short about immigration. That was the most commented one we ever had, right?
Yeah, you took a lot of flack for that. No, it has nothing to do with immigration. But I am going to give the Fed credit right now, and I'm going to say that they have done an excellent job of outsmarting us these last several months. So hear me out.
That is a bold theory.
The Fed's in a really precarious position right now. So they've so far, who knows what's going to happen in a couple months, but so far they've achieved a soft landing, but they don't have any idea what's around the corner. So they don't know, is inflation going up from here? Is inflation going to continue to go down from here? Unemployment has ticked up to just under 4%. Does that mean it's like kind of topped out at 4%, or is it going to continue to go up and get bad? Are Americans going to keep spending money and GDP going to keep doing well, or is credit going to run out? We don't know. We don't know if things are going to get bad or things are going to keep moving along well. And because the Fed doesn't know if things are poised to stay strong or to spiral out of control right now, they're in a really tough position. So first, they need to continue to kind of bolster optimism to make sure that investors and everyday Americans are feeling good about the economy. And they're doing that by saying, we still feel like there's going to be 3 rate cuts this year. And by saying we still think there's going to be 3 rate cuts this year, everybody's excited, everybody's optimistic, everybody's happy. Rate cuts make people happy. The problem with that is that if the Fed just talks about rate cuts and they don't actually do it, then we're going to catch on. And public sentiment's going to turn, and we're all going to be pissed off. And
I don't know. Are we going to catch on? Because they keep coming out with these job numbers and then revising them lower, kind of just on page 6 of the newspaper, and no one ever catches on to that. So,
yeah, but the rate cut thing is a big deal, and it's the thing that everybody's waiting for. And if they don't actually cut rates in 2024, I think it's really going to hurt their reputation. I think it's going to hurt the economy. So they need to be able to credibly say that they're going to cut rates this year. They're actually going to have to cut rates this year. But we discussed a couple of weeks ago that if the Fed were to cut rates today, what would happen? The markets would go nuts. There's trillions of dollars sitting on the sidelines. It would flood the market, and inflation would just absolutely skyrocket. So even though the Fed needs to cut rates this year to keep their promise, keep people happy, if they actually did it right now, it would destroy things. So how do they continue to brag about upcoming rate cuts to keep everybody optimistic, but also actually deliver on those rate cuts without spiking inflation? My theory is that the only way to do that is if the Fed is kind of secretly or behind the scenes kind of taking steam out of the economy right now to the point where a rate cut or two wouldn't hurt us 3 or 6 or 9 months down the line. And so the question is, what could the Fed be doing right now to kind of take steam out of the economy, to hurt the economy a little bit behind the scenes so that in 6 months to do a rate cut or two wouldn't actually result in a spike in inflation? And my theory is that if you dig into the data, you're going to see 2 things. First, you're going to see that the Fed has been rolling assets off its balance sheet. So basically, when the Fed wants to put money into the economy, it buys lots of assets. It takes assets out of the economy, puts money in to buy those assets. And we've got a lot of money in the economy that spurs things on. When they do the opposite, when they start selling stuff off their balance sheet and pull money out of the economy, there's less money in the economy. And when there's less money in the economy, it kind of acts like a rate increase. Basically, people don't have as much money to spend and inflation goes down. And so what we've seen the Fed has rolled assets off its balance sheet. It's reducing its balance sheet. And second, that's causing the money supply, the M2 money supply, to reduce as well. And so I'm going to bring up a graph here because I think this is really interesting. But
let's take a look at your cherry picked graph. Let's take a look at it.
It's not a cherry picked graph. So, I mean, it's the two things I said. It's the Fed balance sheet and it's the M2 money supply. So if we start with the Fed balance sheet, what we see is that basically the Fed in 2020, for anybody that's just watching this or listening to this, not watching this, so what you'll see is there was a big spike, about $4 trillion in 2020, and then another $3 trillion since then that has gone onto the Fed balance sheet. But since last year, a year ago, so March of 2022 or June of 2022, when we were at about $9 trillion on the Fed balance sheet, we're now down to $7.5 trillion. So the Fed has rolled off about a sixth of its balance sheet, about 15% of its balance sheet just in the last year. And that's huge. And we don't talk about this very much. But here's the bigger thing. If you look at this graph, and this is the M2 money supply graph, what you'll see is, and this only goes back to what, like 1975 or so, but we haven't seen the money supply shrink. If we could take this graph back further, you would see that we haven't seen the money supply shrink since the 1940s, since after the Great Depression, after World War II. That was the last time we saw the money supply shrink. Money supply is always increasing until about 2 years ago. About 2 years ago, the M2 money supply was about $22 trillion. Today, 2 years later, we're at about $20.7 trillion. So the M2 money supply has gone down for the first time in 80 years by about $1.3 trillion. And we don't talk about that very much. And the fact that we don't talk about it is basically the Fed getting away with, behind the scenes, tightening the money supply, tightening monetary policy, hurting the economy to a large degree, without us really talking about it. And I believe that if they can roll enough off their balance sheet, if they can reduce the money supply enough over the next few months, it's going to slow the economy down to the point where they can really cut rates and not spike inflation. And I think that's exactly.
This was my prediction. I said at the first of the year, I said they're not going to lower interest rates. They're going to lower the balance sheet, and balance sheet reduction will be their main way to do it without having to revert to lowering interest rates and overheating the economy.
Well, I normally don't listen to you, but clearly my subconscious heard that.
I know. See?
Clearly my subconscious heard it, and now I believe it. And so I think this is the Fed's way of being able to talk a good game and actually be able to carry it out in about 6 or 9 months when they've pulled enough money out of the money supply that the economy really has started to slow down. They're going to get everything they want.
They did talk about it when they started cutting too, though, because they talked about the fact that they were planning on quantitative tightening.
They always talk about it. They mention it in one sentence or two sentences.
Right, but they went into it a little bit. I think it was in one of the questions where they even put a number on it, and they tried to say like, oh, it equates to like a quarter point rate reduction by just us tightening. So like if we tighten, like that's going to be the same as raising rates. And like, so they actually did put a number on it, and it just kind of, I don't think anyone like picked up on it as being important.
Nobody cares though. That's why. And that's what I was saying like in the fall is nobody cares about the balance sheet because it doesn't affect how they execute. So when you look at businesses, everything else, that's the front end, not the back end, even though it does have that effect on the money supply. That means they get to have their cake and eat it too. So their losses, by the way, did you see that $150 billion plus in 2023, the Fed's losses were one of the largest, if not the largest ever. But that reduction of that balance sheet, they came out and they started mentioning it in the fall, but they mentioned it right at the point where they're like, yeah, we're not going to lower rates. So they said, we're not going to lower rates. And then they mentioned it really quickly. But if you looked after what they do, they were actually being aggressive about it. And it was, I thought it was a very clear path, and it makes sense because inflation, the balance sheet, right, look, has way less effect on Main Street inflation. So when you look at the price of goods, services, things like that, that is much more reactionary to interest rates because it is a quick way to inject capital into the economy, where the balance sheet has way more to do with the money supply that doesn't hit Main Street. So all of a sudden, you can have your cake and eat it too. We can keep the price of eggs, bread, things like that down through high interest rates, and we can be lowering the balance sheet to get away with kind of the effect of it. It's an interesting tactic.
Yeah, I don't think these things are as connected as I think you guys are. Like the money supply, the M2 money supply is primarily dictated by two things. In fact, it's exactly dictated by two things. One is the amount of commercial bank lending that's going out. The commercial banks are the ones that actually create and contract credit. I mean, the Fed tries to manipulate, their ability to do so, but at the end of the day, if they're not lending, money supply goes down. If commercial banks are lending, money supply is going to go up. And then the other way that money supply goes up and down is when the federal government themselves, the Treasury, starts literally printing dollars like they did in 2020, 2021, and dump those directly into the checking accounts of each individual. That will also increase the M2. And what's happened since 2020 is you've seen commercial banks struggling. You've got all these buildings, commercial buildings are in trouble. Office, we've talked about on the show a lot. So banks are really tightening up their lending standards. They're really shoring up their balance sheets. They're not lending as much as they can. The government has stopped, obviously, sending free money to people's account. They've stopped the checking account. And for you to say, Jay, how can you possibly sit there with a straight face and say that they've achieved a soft landing is beyond me. I mean, they've taken off the plane, but they have come anywhere near. Let me. You actually shared the graph. I pulled it off a different version, but let me just share the thing I'm looking at right here.
I really thought you were being sarcastic there for a second.
So check a look at this. So if you look at, I mean, I can go back to 2008 if you want to, but 2008, our balance sheet was literally about just under $1 million. I think it was $900 billion, and then spiked it up to $2 trillion. And I remember during the whole little process, Janet Yellen saying, "Oh, we're going to reduce our balance sheet. We're going to reduce our balance sheet. We're going to reduce our balance sheet. We're at 0% interest. But no, we're going to start selling the stuff on our balance sheet. We're going to come back down to normal, which is 800 billion, less than $1 trillion." Since then, that continued to go up and up and up. And even right before COVID, we were at about $4 trillion. And when COVID hit, it basically doubled from 4.1 all the way up to 7. So not quite 7.1, not double, but pretty high. And right now, yes, it's gone down, but right now we're still higher than at the highest point right after COVID. So it took a little bit of a dip in 2020, middle of 2020. It kept going up all the way up. But even where it is today, it's still higher than its highest point from when they printed all that money to save the economy in 2020. And so to say that they've actually landed the sucker, I mean, first of all, you'd have to argue they'd have to get down to $1 trillion to land this thing. But they haven't even gotten back to the peak of when COVID came in. And if you want to go back to pre-COVID levels, when this emergency facilities came up, we're at 4.3 trillion. We're almost double where we were prior to this latest, run up. So to say that they've achieved a soft landing, I think is a stretch.
You also need interest rates to stabilize before we could call it a soft landing.
Let me clarify. I think we've achieved a soft landing given where we are today. I think it's safe to say for the last 40 years, we've screwed this economy up, and everything we've done over the last 16 years since 2008 has basically been a Band-Aid. So I'm not saying that the economy is in a good place overall. I'm not saying that I think the next 20 years, 30 years, 50 years, that we're not in for some major reckoning. But relatively speaking, compared to where we were 4 years ago when COVID hit, I don't think anybody would have thought that we could get to a point where we could get interest rates stabilized, on their way down, presumably, people optimistic about the economy, and no major recession. And so, again, it's a relative thing. I'm not saying the economy is great compared to 40 years ago. It's a Band-Aid, but we've achieved what we were trying to achieve 2, 3, 4 years ago.
But my point on the analogy, and people use that analogy, that's a good one. It's like, hey, the Fed took off on the plane, and great, and now we're all celebrating. Or the Feds, I don't know if they're taking a victory lap, but we're still in the air. We're circling around we're circling around in the air, and at some point this airplane needs to land. And right now we're just circling around. Oh, look, everything's great. but we haven't landed the plane. So a soft landing is like when we land the plane, what does that look like? Is that going to be a hard thump? Kyle's hat's already running over. That's
Well, so what does that mean? Like when you say land the plane, do you mean getting the debt down below $10 trillion, getting the Fed balance sheet down to $1 trillion?
People are saying no landing now too, that we could just keep the plane up and plane doesn't even have to land. So that's the
But
talk.
interest rates at 8% isn't landed because it is not sustainable. So there's no way we can say the plane landed. So if interest rates, if this is landing, the entire U.S. economy will implode in 3 years. You cannot run our economy at 8%.
At some point, they have to get down to what they consider the neutral rate, right?
Yes, exactly. So right now, the spreads between the cost of money, assets, total returns, right? I mean, we can't even take a hiccup. So there's no way that we have a functional economy today, not even close. So if that is the case, how could we even call it a landing? Whether we're sitting here trying to buy time before 8% interest rates.
Well, I do have to point out that Mauricio and I, we did predict before that Q1 something would happen by the end of Q1, and we are coming up at the end of Q1.
Mauricio predicted Q4 of last year.
Yeah, well, I said the end of Q1. I thought it would come with this bank term funding and all this stuff, and we are getting days away from the end of Q1, and so I will admit, I guess I was wrong on this. But I also, something that has been breezed over that has come out recently that I believe could be the reason, and I might just be, trying to confirm that there's an outside factor of why I was wrong. But have you guys seen the productivity numbers? Like I'm now, once I read into the productivity that's going on in the US, I'm convinced that that's the reason why everything is going so well. And we had low productivity for a while there, but if you look back at like Q3, Q4, like Q3 was like 3 point something, and Q4 was 2.7 productivity. So like for anyone who doesn't like how they measure productivity, they basically say, okay, what's the increase in the labor, and then what's the increase of goods produced, and so. Right. And so the last couple were like the goods produced rose by 3.7%, and the amount of time employees worked only rose by 0.4%. So that's how you get the delta. And if you look at that, like it kind of makes sense, right? Like if we aren't working any harder, but we're producing more things, the GDP makes sense. The inflation coming down makes sense. A lot of these things make sense. And to AJ's point that he just said, like, is this not necessarily even just AI? This is like the automation, the culminating in AI that is changing the way our economy works. Like, is that why we're seeing all these things that typically would lead to a recession just haven't?
You can see it's interesting looking at first to clarify, I completely agree with you, by the way, Kyle. And I think that if it wasn't for that, we would, because what would have to happen is labor force would have to shrink, but productivity would shrink with it. But as of right now, I think to clarify soft landing, a soft landing means we get to so what they did is they rose interest rate to stop inflation. Now they're saying we need to get a soft landing, meaning we need to get interest rates down without that resulting in a recession, right? So they're like, can you do that? Can you actually say we went to 8% and now we're bringing it back down, and we did that without imploding the economy, right? Well, interest rates may be coming down, but I mean, they haven't.
Why,
right?
why do we need interest rates to come down, though? I mean, what would be so horrible if interest rates stayed where they are today?
So now I need to be careful with this because that was one of my main arguments, is that they may never, ever go back down to what they were. But if you look at the debt markets today and the restructuring, the banks have basically been told for how big trillions of dollars is the commercial real estate market alone. What the banks are doing is they're pushing off, and they were told to by the administration, and they were given the power to do it. So one of the main reasons we haven't seen defaults is because they're pushing them off. So the banks are doing not restructuring, they're actually extending, and everybody's extending and holding off until they can get to a place where the debt can turn over. It can't right now. We have so much debt in the United States that is not viable at certain levels. And I think the longer that this goes on, the more you have this mass erosion away. And then all of a sudden you have a complete restructuring of the economy that I don't think has taken into place.
Government debt too, not just real estate owners. And like the government, like if we keep rates this high, then all of a sudden these new treasuries that are coming on at these higher rates are going to start replacing the older treasuries that are rolling off. And
municipalities are done at these rates. They have these locked in, and you have these different terms, which one of the worst things we ever did was talking about that.
So what you're saying is the economy is going to get bad and we're going to have to lower rates.
Well, yeah. And then we don't have a soft, you're exactly right.
Your point was we can't lower rates. And what that's going to lead to is the economy getting bad to the point where we have to lower rates.
Exactly. Then we don't have a soft landing. It doesn't exist because the economy got bad. The whole idea of a soft landing is that you get to a nominal rate without a rate.
If we wait till we have to lower rates, something bad happened. And that, to AJ's point, that's not a soft landing.
Here's a more of a philosophical question, which is everybody's like, we don't want anything bad to happen. I mean, do you guys think that a recession is actually good? Is there an argument to be made that a recession is a good thing? It's a necessary thing. It clears the market.
100%.
You've got to get through that.
Recessions are
100%, right? I mean, the analogy it's not my analogy, but I think it's a great one. And I'd love to get your take on this. I've heard this before and I'm like, this is an amazing analogy. You tell me where this analogy fails. But it's like you have a freaking drug addict, right? Who's addicted to drugs, who's addicted to heroin, and he has to go through the withdrawals in order to get fixed. He has to go through that pain of going through the withdrawals before he can get sick. He can continue to get more drugs and postpone the eventuality, but he's never going to get well, or she's never going to get well until they go through that withdrawal and that awful period of time. But it's a necessary evil because you are where you are now. You're a drug addict. You're addicted to whatever drug you are. We're addicted to cheap money. We're addicted to credit. And in order to clear that out and come on the other side, we have to go through that pain. And if we don't go through the pain, we're just kicking that can down the road. And the heroin addict, the drug addict, is just going to take another year or 5 years, but eventually they have to get through that.
The easiest other side of that analogy, though, was if the withdrawal kills the addict, I guess is the problem, is that, okay, if we just let the economy go through withdrawal, like how many businesses are going to die? How many companies are going to die? Is there, what's going to happen to the...
Well, they should die. There's a lot of businesses that should die.
They should die. Absolutely. They should die.
There's a lot of in my world, there's a lot of real estate syndicators that shouldn't be syndicated, that shouldn't be buying properties, and they're getting punished. And that's fine. That's the market punching them in the face and saying, you know what? You don't know what you're doing. We need to clear you from the market and keep the good ones like Jay and Kyle and AJ, make sure they stay along because they're going to survive and the strong survive.
But in the process, we could lose a lot of our superiority and advances and, a leader in development and tech. And like, we could lose a lot as an economy. And so like, it's whether or not we want to be in a position like that.
We've gone through recessions. The recessions are as much a part of the economy as the bull markets are. You don't have one without the other, and you can't.
Here's some math for you. We've had 33 recessions, maybe 34, depending on if you want to call the last one a recession, in the last 160 years. Somebody divide 160 by 34. What do you get? Somewhere around 4.5. On average, every 4.5 years in this country for the last 160 years, we've had a recession. Ray Dalio talks about this. I talk about this in my recession book. That
you're trying to compare yourself to Ray. Are you in the same league as Ray Dalio?
No, I learned from him and I copy off of him. He's like the smart kid in class that I sit behind and I go, ooh, that I think that's the right answer. I'm gonna copy that.
That's the smartest thing Jay's ever said, and I agree 100%.
Well, but going back to Mauricio's thing though, the problem is that like with the heroin addict, there's someone who does recreational heroin and then says, oh, all of a sudden, like, this is bad for me, like I need to cut it. And then that's a typical recession. But if you're like really feeding the heroin addict to the point where like they're so addicted and they have so much heroin that cutting them off would kill them, then like you need to do something. And I agree that a recession, like a healthy recession, but I'm worried about right now, like if we just all of a sudden cut off or do something wrong, then it breaks like important shit in our economy instead of just having a typical recession where we feel a little bit of pain, we come out the other side and we're fine.
I like that. So I like that. So your analogy is actually, it's a great one. So you're saying, hey, if you have a drug addict that's really hooked on heroin, really bad, like really almost to the end, and you say, well, you got to go through the pain before you can get clean, and we just cut you off, then there's a chance that the heroin guy can die, and that's worse then what though? Worse than stringing him along and being a heroin addict till the rest of his life?
Well, you wean him off, I guess, is it would be the typical thing, and
You do a soft landing, is what you're saying.
and you just do something, I guess, is the thing, instead of just cutting them off. And I would say, if you want to use that analogy right now, we fed the heroin addict quite a bit of heroin.
Oh, 100%.
Like, quite a bit. And so, and by doing that, we created our own monster. So like I guess it's not a bad theory that we need to do something in order to get us back to kind of level.
So like, going back to what Ray Dalio talks about, basically every time, so we have these cycles, and we have recessions every 4, 5, 6 years. They've gotten longer over the last couple decades, but every 4, 5, 6, 7 years, and every peak gets a little bit higher, and that peak is measuring basically our debt load. So in every cycle of the economy, our debt load is a little bit higher. We take on more debt. Then we have a recession, and we basically get rid of a bunch of that debt. People go through bankruptcies and foreclosures, and they lose their stuff, and so we go through that recession. We don't go all the way back down to the last one, and so then the next one goes a little higher, and then we go down, but not as far down. The next one goes higher, and we have these cycles, which we think of them as a sine wave, but it's actually a sine wave that keeps going up and to the right. And then in Ray Dalio's, he's a student of history. What he said is about every 80 to 100 years, we've built up enough debt. We've moved up and to the right enough that we have to have this major, what he calls a deleveraging, where all that debt that we've built up over the last 80 to 100 years just gets cleared away. And those are depressions. And the last one we saw was obviously in the 1920s. And in Ray Dalio's estimation, 2008 should have been the next one. The problem was we didn't let it happen.
Long-term debt cycles and short-term.
Yep. I don't know if this is from my book or if it's from Ray Dalio's book.
That's Ray Dalio's.
It looks the same because I copied his.
The source is the short and long-term debt cycle. If you're listening, short and long-term debt cycles. Source Ray Dalio. I'm sorry, Jay Scott. How to copy Ray Dalio and how the economy works.
So a lot of people have done this chart, but he gets credit for it because he wrote a whole book on it. And so, yeah, I mean, anybody that's looking, anybody that's watching this on YouTube, you can see this, but it's basically those short-term cycles. And
the short-term debt cycle is within the long-term. The key factor is the short-term debt cycle is controlled by the Fed. So whenever you have a short-term debt cycle, the Fed, a lot of people don't understand this, is actually the one that contracts and expands the money supply. Now, the long-term debt cycle is different, and that's where it's really important, meaning that it goes off the rails and the Fed cannot not control those short-term cycles. The debt is so much that they cannot simply expand or contract money supply through normal efforts. Now, what happened in 2008 that was so different from the Great Depression and any other time is they didn't allow the contraction. Instead, they didn't allow the eradication of debt. What they did is they transferred it. And this is where people forget. What they did is they moved it from one pocket to another, out of the public pocket into the Fed's pocket. So then you have this waste, this pile steaming waste still there. It's still there. It hasn't gone away. And all of this debt, which still affects money supply, everything else, but it's sitting on the Fed's balance sheet. So the economy now isn't nearly affected by it. But what has happened is that is not like Mauricio was talking about and showing, that has grown so astronomical that the Fed now is having to do something. And that's a problem. So the question is, did we actually go through it? And was that enough? Was 2008 enough? Did we erase enough debt off, or did we simply prolong this long-term debt cycle? Now, if you look at the last long-term debt cycles, not only in the United States, but others, it's really worrisome because there was always a prior recession. So the actual restructuring happened after an initial recession. So the worry and the question was that 2008 was the prelude, and it was not the main event. And the main event is coming, and the Fed will not be able to expand its balance sheet due to inflation and inflationary rates. And so instead, an actual restructuring of debt will have to go on, and we have to eradicate debt off the Fed's balance sheet, the public's balance sheets, where the public assets have swollen. On local levels, it's insane what has happened on local municipalities. That is the debt crisis of today. It's a government debt crisis, but it's because we transferred it. So we went from a private debt crisis to a public debt crisis. And the public debt crisis is very different than a private debt crisis, because a private debt crisis, just go away. You went bankrupt. You're done. Investors, they took a wash. The bank, you write it down. This really sucks. Sorry, everybody, you lose all your assets, right? But when a municipality goes bankrupt, that's not what happens. The investors don't just get wiped out. When the Fed goes bankrupt, there is no one to just walk away. And that is the big danger of this balance sheet that the Fed has: high interest rates that local and national governments can't pay. And so this long-term debt cycle and the debt that the government's taken on, that's the big concern.
That was gold.
And let me bring all of this, and that was absolutely great. Let me bring all of this full circle, going back to something Kyle said earlier. We talked about the fact that every economic peak is higher than the last peak. Basically, every economic cycle is better in terms of GDP, in terms of economic output, than the previous cycle. And you know what drives that upward trajectory of the economy? It's productivity. That's the reason why the next cycle should be higher than the last cycle, because we're getting more productive, we're getting more efficient. And the scary thing is, what we saw in 2008 was largely driven by the huge productivity gains that we saw after the internet boom in the 90s and early 2000s. We saw so much productivity gain and so much economic output gain for the previous 10 years that we had built up all of this debt, we had built up all of this baggage that it had to be sloughed off.
And it was manageable as the productivity was growing. That's the key, though. It was manageable because the productivity was growing and our GDP was growing and our tax bases were growing. That changed after 2008. After 2008, most of the economic gain that came did not come from productivity. So the internet transferred from a infrastructure and a productivity to a consolidation phase. So the internet, which gave mass productivity and mass gains across sectors, everything else in the 90s, early 2000s, transferred into the internet, consolidated all of that, and it made individual companies and individual people astronomically wealthy. So the wealth that was produced was incredible, but it didn't result in productivity. It resulted actually in the opposite. It gave us social media.
You don't really have to be that productive if money's free too, right? Like if you're
Right.
able to just
That's where I was going. So when you get to the point where credit is so easy, remember, when you have more credit, you have more debt, you basically have more money to spend. And Ray, as if I'm enough for my buddy Ray, he does a very nice job of explaining that, one man's spending is another man's income. Right. So as I have more debt, more access to capital, I spend more, which means somebody else gets that money and their income comes up. But what ends to happen, which is we haven't really touched on yet, and Ray talks about this very well, is that right now, and I'm sorry, I got my cursor, you guys can't see it, but at some point that starts to change. And what Ray Dalio is concerned about is that we're at the top of this peak. So we're coming down on the last little short-term debt cycle, and the next one's all the way down to the bottom, because as that debt disappears, as the money supply shrinks and you have less money to spend, that means you have the other man's income is now going down. And it just becomes this spiraling effect where less money for me to spend means less income to the next guy, which means less money they can spend, which means less income. And it becomes this deadly spiral that at the end of a long-term debt cycle, you don't stop at the, higher than the last bottom. You just keep going all the way down to completely wipe out the system.
Yes. And this is actually a normal functioning part of it. One of the problems is the more a society gets unwilling to suffer pain, the more that they try to offset it. So the difference between the 1940s and 2008 was our acceptance of pain was way less. And so they did things so we could offset it. And all of the recessions, first of all, we're going way longer without having recessions. People's aptitude for them are less. Politicians get thrown out. And so we just haven't been willing to deal with pain like the economy used to have, the contractions we used to have. So how do you offset pain? Debt.
But AJ, that's something we've changed too, because in the old days we'd have a recession and we'd be like, oh, hey, it's a recession, it's normal, the end of the cycle, we'll let it happen. And since 2008, I think they've had this kind of experiment where it's like, hey, let's just print this money, or let's encourage the banks to go print money, and that kind of seemed like it worked. And so now there's this belief, I think, that if something were to happen, the first thing that's why I keep saying interest rates at some point may go down to zero again, because if there's some catastrophic event and the world's coming to not an end, but like similar to COVID or similar to '08, the Fed's just going to go from 5% to zero to try and stimulate as much of the economy, because that's the new playbook that didn't happen back in the 70s. If you remember, back in the 70s, it was the complete opposite. You have Volcker jacking up rates to 18% or something. But can you imagine Powell jacking up rates to 18% if something were to go wrong?
Well, it's obviously a little bit political too. We already talked about the fact that I'm sure every political incumbent knows now that no one survives a recession in the year of an election. So they're going to try and push that off every time that they can. And now that they have this playbook from 2008 that, hey, we could just, print money and things go well and there's no recessions, then while it's their term, why would they worry about this? They're only around for 4 years. Let's just make sure I don't have a recession in my election year and everything's fine.
100%. When you look at these longer cycles, and what we've seen in the United States is the aptitude. I mean, you have a working generation right now that's never been through a recession. That's wild to think about. Over 50% of the current workforce was not in the workforce when there was a massive recession, or a recession at all. That's crazy. I mean, that's never existed in the history of the United States. And so our sensitivity, unfamiliarity with it, and our overall just ability not to withstand anything results in low savings. It results in absorbent amounts of spending. It results in more debt, which all of this keeps fueling that underlying problem that we've been talking about. So the restructuring part is what theoretically has to happen, but there is a savior that a lot of people think, and it is AI. Some people honestly believe that AI will be the savior of this, that productivity will get so good because of it that we can basically outproduce our way out of this. Like, that is our way out. And I don't know if that's true or not. It would be amazing if it is, but there's an argument for it.
By the way, Kyle, make sure we talk about that, because it just occurred to me, because I'm a couple glasses in the champagne. I just thought of this literally on the spot. But what happens, AJ, if I know this is not an AI segment, but if productivity goes up, but it's only because 5 people who can use AI can do that increased productivity, what happens to the other 95% of people who are completely worthless because they can't do anything and compete with the 5% that does all the
universal basic income?
It creates more jobs too, though, right? Same thing with the internet. Everyone was all worried the internet's going to kill all these jobs, but then they just get new jobs. And there will be some people.
Universal
basic income. That's what AJ is fighting for.
This whole segment, I love the fact. I just need to point out that this whole segment took such a dark turn. We started out talking about a soft landing, and here we are talking about an economic death spiral.
It's a nuclear winter, guys.
I started looking up how to buy citizenship into St. Kitts. So
we've been invested in bunkers.
Yeah, apparently you can buy $250,000. That's all it takes, investment, and then you can get citizenship.
You're right. We did spiral off a little, there's no doubt. But this is a great conversation, you guys. This was awesome.
I agree.
Economic death spiral. That's the topic. That's the name of this.
I know the AI discussion's coming soon, so
yeah, we'll do that on a new segment, and we promised Mauricio a segment this week too, because for those of you who are tuning in for the absolute first time ever, Mauricio just released a book, and it turns out not only is Mauricio a syndication attorney, but he used to dabble in asset protection as well. So since
I don't want to say dabble. Come on, I was like a freaking pro.
Well, you could prove it in a second, because real estate can be pretty litigious industry. So I thought we should hit him up for some free advice while we have him here and locked into our podcast. And so, Mauricio, is proper asset protection really that important for real estate?
Dude, this is going to be a tough one to talk about asset protection. But yeah, just for you guys that don't know, I used to be an asset protection attorney. Obviously, I don't do that anymore. I'm now purely a syndication attorney, but I've been doing this for a long time. And a big portion, not to plug my book, but a big portion of the book does deal with asset protection type topics, whether it's actually entity formations or insurance or privacy or asset protection trusts or all that kind of stuff. But look,
I feel like none of this is important now that I'm like sitting here concerned that we're in an economic death spiral.
Yeah, it really doesn't matter. It's all over.
well, this is exactly when you need to be concerned about this, because when things are tough, people tend to try and get some money some other ways, and your likelihood of getting sued, I think, do go up during a recessionary and tough time. So
Jay doesn't even know how many lawsuits that we are in as a company. He can't even list them right now. So
let me tell you this. That's one of the problems, right? So I believe we live in one of the greatest countries in the world, but we also live in one of the most litigious countries in the world, right? We have 40 million lawsuits filed every single year, which turns out to be 100,000 lawsuits per day. I used to do the math of every minute and every second, but 100,000 lawsuits a day. And when it comes to lawyers, doesn't get much better. We have 1.3 million of us, my friend. 1.3 million Mauricios running around the country, and that comes out to about one lawyer for every 248 people. So, and by the way,
isn't there like a stupid percentage of the entire world's lawyers in the U.S., like 95% or something?
It is. It's a stupid percent. And by the way, there's no end in sight. Like if you look at law schools are not hurting for admissions, and they're going to be spitting out even more attorneys over here. But there's a reason for that.
What do you call the guy who finishes last in his class in law school? A lawyer.
What do you call 10,000 lawyers at the bottom of the ocean?
Good start.
A good start.
Good start.
But yeah, look, I think asset protection is critical because, as entrepreneurs, and it's not just related to real estate people, but real estate investors, businesses, anytime you have a business or real estate, your odds of getting sued go much, much higher. It's difficult to pinpoint, but you probably have a good, at least 1 in 3, 1 in 4 chance of getting sued at some point in your life. And the question becomes then does that mean you're going to lose all of your hard-earned, productivity and wealth that you've created over the years and go all the way back to square one? Or do you have some kind of a safety net, whether it's insurance or some entities or what have you, so that when that does happen, because it is going to happen, you are going to it's not a question of are you going to get sued? It's going to be when are you going to get sued? And are you going to be in a position where the lawsuit doesn't cripple you, right? And that's one of the reasons people have insurance. And I think insurance.
Well, you brought up a good one there, Mauricio. So that my insurance guy tells me, like, you just get adequate insurance and you should be fine. Isn't that enough?
Yeah, absolutely not. So that I can have a whole episode on insurance, but one of my pet peeves with insurance is that, first of all, insurance is always your first line of defense. Everybody should have insurance. You buy a rental property, you better darn well have an insurance policy. If you start a business, you want an insurance policy. Insurance is your first line of defense. However, insurance has holes in them. There's generally, I complain about insurance because there's 3 things. Number one is that most people, first of all, they're underinsured. They have I have $1 million policy or $2 million policy, and that's great. But what happens when my alma mater, UC Berkeley, had an apartment complex where the balcony collapsed and it ended up killing 6 or 7 people, students, right? Your $2 million insurance policy is not going to get you past, paying attorney fees, right? So that's number one. But number 2 is there's so many exclusions to an insurance policy. I have a hard time reading insurance policy, and I consider myself I know you guys disagree, but a relatively intelligent person. And I have a hard time sifting through an insurance policy because there's so many exclusions. So my biggest pet peeve is people are making their premium payments every single month thinking they're insured. And it's really a false sense of security, because when something actually does happen, that's when they find out, they get the rejection letter and said, hey, you didn't read paragraph 734th footnote number 27, where we took out that coverage and you're not covered, or you're limited to this, or you're limited to that. So that's one of my really big issues with insurance, is that they just have a crap load of holes in them. And so the way you remedy that is you have some kind of an entity as a backstop. So I think you should think of entity, especially in the real estate world where we use limited liability companies, LLCs, as a backstop. So if insurance isn't enough, or if insurance fails for whatever reason, or whatever insurance isn't there, you have a backstop and you don't actually lose everything. But to your point, Kyle, too, not everybody needs some fancy. I mean, AJ needs a fancy offshore asset protection trust because he's, gangster rich, as we talked about last episode. But if you're just starting out, right? You're just, you're a W-2 employee. You've purchased your first rental property. You don't need anything fancy. You're going to need something a little bit more basic, maybe an insurance policy coupled with an entity. But, I always think of these things in layers, and it depends on where you are in your journey. Are you just starting out, or do you have a multi-million portfolio with, 13 different properties? You're going to need a different asset protection strategy. AJ cannot survive alone. Sorry to pick on you, buddy. On insurance. Insurance alone is not good enough for AJ. He needs something more sophisticated. He needs an entity structure, maybe a trust, etc. But if you're starting out, maybe insurance with one LLC, that might be enough. And it just depends on where you are on the structure. But the most important thing I think to understand is just here in the US, everything is based on ownership, right? So if you own something, if you own a piece of real estate in your own personal name, you are exposed, and you have unlimited exposure, by the way. It doesn't matter that your little property has $20,000 in equity. If somebody were to get hurt on your property, like a tenant slips and falls, or maybe a boiler explodes because you failed to check it and it causes serious injuries to your tenant or anybody on the property, the owner of the property has unlimited exposure. And so you don't want to be that person who owns that property. You want to have that property owned by a separate legal entity like an LLC, so that the responsibility and the liability falls on that LLC, and you're only exposed as to what the LLC owns. What's inside of that LLC was generally the equity in the home. But anyway, so this topic
I think everyone who listens to, I shouldn't say everyone, but many people who listen to this, because we do talk pretty high level, and they probably get the concept that when you own real estate, though each individual property or each individual investment should be an LLC, and you should have insurance on top of that. I think where people get tripped up on the other side of it is, okay, once you've accumulated a decent amount of assets, real estate assets, you have to start thinking of the other side of asset protection is what if something happens to you personally? So like, what if someone steps on your property, slips and falls on the ice, and they go and look at go to a lawyer and say, hey, I fell on this guy's property. And the lawyer looks up you and it says, geez, this guy's got $5 million worth of real estate. We're going to come after him hard. So I guess what most people don't protect, they've heard through Bigger Pockets podcast, or they've heard through something that, okay, you need an LLC, and then the insurance guy says you need insurance. But what about if someone wants to come after you personally and take away your real estate?
Yeah, that's a great point, because when you're thinking of asset protection, there's two sides of it. There's two angles, right? So the one I just described earlier, that's what we call generally an inside attack, which means something happens to the property itself. Like I said, somebody slips and falls, a boiler explodes, something happens. And so the owner of that asset is exposed. But what happens, the example I like to give is what happens if something happens to you, Kyle, unrelated to your properties. Like the example I give in my book is, you're backing out of your driveway because you're late at work and you end up running over the kid on the skateboard, right? Or you get into a car accident, and major damages occur, or just some other business dispute. Something happens to you.
Or your kid or your dog does something.
Yeah. Something happens to you unrelated to your assets. So forget about the assets. It's just you get sued personally, and there's a judgment against you personally. Now the question becomes, okay, now I have a judgment against Kyle for $5 million or whatever the number is. What does Kyle actually own? Let me figure out what does he own so I can go after those assets. And that's where you want to have these entity structures to make sure that these assets are in a place where they can't actually get access to the assets themselves. They won't be able to get access to ownership of those assets. They won't be able to get control of those assets. They'll essentially be limited to some sort of financial, like whatever distributions we're going to go to Kyle, hey, we maybe divert those to the creditor. But to protect the control and ownership of those assets, that's where the outside attack, and that's where creating entities in certain jurisdictions, like the ones that you've always heard about, the Wyomings, the Nevadas, the Delawares, now the Texases, by the way, if you live in Texas, it's just as good as all those now. That's where you want to have those entities. That's what you ultimately want to own. If you're not going to go fancy and do an offshore trust or some asset protection trust, which not everybody needs, if you're not going to do some sophisticated equity stripping or whatever, you want to be limited and own LLCs that are in these really great asset protection states like the Delawares and Wyomings and Nevadas, and have those LLCs own everything else underneath you to protect you against those outside attacks that have nothing to do with your properties. But again, the car accident is probably the easiest one, making sure that when there's a judgment against you, they can't actually access your assets. They're going to be limited to what's called a charging order, which nobody wants, by the way. And you got to remember, Kyle, that the plaintiffs' lawyers, right, the lawyers that represent the people suing you, they work on a contingency fee basis, which means that they don't get paid unless you get paid. And that's a very unique structure. That doesn't happen I don't know if it happens in any other country in the world, but in the United States, somebody wants to sue you. That's why it's so easy to sue. They don't have to come out of pocket themselves. They can just hire a lawyer. Lawyer won't charge them a dime, and they will only get charged if they get a judgment. And I used to work for a really well-known, I won't say it because there's a lot of listeners in the Bay Area, but I used to work for a really well-known, plaintiff's attorney that had late night commercials that, it was a kind of a well-known guy. And he wanted to make sure that he was going to be able to collect if he won the lawsuit, because there's no point in winning a lawsuit and spending 3 years of your life getting a lawsuit and getting a judgment if I can't collect on it. And so by structuring your affairs to a point where they either can't find them, or maybe more importantly, they can find them, but they know it's going to be virtually impossible to get access to them, and that they're going to be limited to what we call a charging order, that's just a big dissuasion from one of these plaintiffs' lawyers. They'd just rather settle for insurance.
To your point, I don't know, it made the news quite a bit, is when the lawyers who successfully voided Elon Musk's $56 billion Tesla pay package, they requested, after they won that case, they requested $6 billion in fees. $6 billion in fees, because they were working on contingency.
Right. That's exactly right. And so the incentive, the good news is you don't have to pay, but you've got to think of, there's always two parts of the lawsuit. One is to get the judgment and make sure that you're wrong, but then you have to collect. And the cool thing about asset protection, which I want to point this out because it's an important fact that I think everybody needs to just realize, is that your ability to pay the judgment, so what assets you have, how much money you have in the bank, where your assets are located, who owns them, are they in trusts or LLCs, that is completely irrelevant. And the plaintiff's lawyer can't ask you about that until they get a judgment. They have to get a judgment first before they can unlock that door and start asking you and searching and poking around to see what you've got. So if they can't find something by an asset search, a bank search or a real estate search, obviously those are easy to find. If you've got a property in your personal name, I can do an asset search relatively quickly and find all of the properties you own, all of your brokerage accounts, all of your bank accounts. And so when a plaintiff's lawyer, that's the first thing we would do when I worked at the plaintiff's lawyer. We would do an asset search and say, does this guy have anything for us to go collect if we end up getting a judgment 2 or 3 years from now? Even if it's a multi-million-dollar judgment, does he have something? If we couldn't find anything, then there's a risk for me. Like, why do I want to go spend all this effort to get, it's a clear-cut case for me. I'm going to win it, but I don't know if I'm going to collect at the end of the day. So I really don't want to spend the next 3 years of my life working on it. Let's just settle for the $1 million policy that they have, or the $2 million policy limit. Let's just go get that. That's easy money, low hanging fruit. I won't go pursue all this stuff because it's all a blind spot until I actually get the judgment.
Isn't this another good reason? And I'm not saying that anybody should make a debt decision based on asset protection necessarily. But isn't this another good reason why, if you're thinking about getting debt on an asset that you own, let's say you own a house, if I own $1 million house outright, that's $1 million in equity that somebody can come after. If I now get a $950,000 loan against that house, I only have $50,000 in equity. Nobody's going to waste their time to come after that house for $50K, but they would have for $1 million.
That's a beautiful asset protection strategy. It's a little bit more advanced. We call that equity stripping, because you're literally stripping away the equity that's in your house. So for example, in your example, you have $1 million, you go to Bank of America and you get even an 80% loan, right? And so you get an $800,000 loan, you put that money in a bank account over here, nothing's changed for you. You still have the same $800,000 or same $1 million. You just have $200,000 in the property and $800,000 in cash. But now if something happens to me and they go after me and they go after my property, they're going to see that there's a Bank of America loan for $800,000. They can go after me, but they're going to be limited to that $200,000, and the remaining $800,000 is safely tucked away in a company that, that's protected. And so what we do a lot as asset protection attorneys, or I used to, is that we would create our own friendly banking companies. We would create our own LLC to act as a bank and do that kind of same equity stripping, but it's a friendly lien. It's a friendly strip because we control the LLC that's actually lending the money. So I'm not advocating that. One of the beautiful things, and this is why I love, not to plug the book, but I will. The reason I wrote this book is that I don't have a dog in this fight. Like I don't practice asset. I'm not here to sell anybody a trust or an LLC or insurance or anything like that. I'm literally giving you the pros and cons. I can poke a hole, by the way, just so you guys know. Every single asset protection strategy has a hole in it. There's no such thing as a guaranteed bulletproof. If you hear those words, you might as well just turn around and run away, because I can poke a hole. Every single strategy has an issue with it. But obviously, if you layer upon layer upon layer, or obviously an offshore asset protection trust, which is probably the gold standard, or an equity stripping strategy, those are much harder to get through, but they're not impossible. You show me an asset protection strategy, I'll tell you how to go beat it, or where the weakest link is. So just be careful when you hear promoted.
You can't eliminate risk, but you can manage it. That's the key. And I think a lot of people are fooled into thinking that they can literally extract risk and get rid of it. That there is a way to do this where I can't be touched or hurt. And that's just not how it works. Now, managing it is different, right? I view it like, let's limit the scope of the risk and what could occur, and let's make it as hard as we can. But at the end of the day, there is no getting rid of 100% risk.
There are downsides to a lot of these strategies too, especially as real estate investors. Real estate investors are unique in that we want to take loans out. We want to show that we make money and we have money. But the problem is that a lot of these asset protection strategies are the complete opposite. They want to show that you have no money and you make no money. And so those are kind of, opposite forces. And so you have to balance that. Hey, I want to be able to qualify for my commercial loans. Well, commercial loans, they look at your net worth and liquidity. Well, if you take up an offshore asset protection trust, you're not going to show you have any assets or liquidity. So you're going to have to work against that. So it's a balance, and that's why it's really good to, you can learn about all these different strategies, but it's not just cut and dry. Hey, this one works for one and one size.
100%. And the same happens with taxes, right? You take bonus depreciation. It looks like, oh, I just lost my shirt and I lost all this money and I got the great tax benefit. But now I want to go get a loan and I show my tax return. It looks like I've just lost $1 million last year, when in fact that's just sort of depreciation. There's a great little triad that we use a lot. It's a little triad, and it has like 3 little components. One is asset protection, one is tax, and one is privacy. And it's difficult to get all 3. Like if you want like tax benefits, for example, you may have to give up asset protection in order to get the tax benefit. Or if you want the asset protection, you may have to give up the tax benefit. If you want privacy, you won't be able to do. So at some point you have to pick your poison. But to address your specific concern, that 100%, like the easiest way to get a loan is have a W-2 paycheck. That's the easiest way to get a loan on a piece of property. So if you don't have that, you've got to work with, there are lenders out there that get this, and you work with those types of lenders because they understand. It's not just check the box. They understand that, hey, here's your offshore trust, but you're the beneficiary of it. So I get it. And they can count that in there. Just like when you're working with lenders who understand that when they're looking at your tax return and you're showing a loss, that doesn't mean you don't have any money.
Fair enough. Any final thoughts and advice?
No, I wanted to, one of the things I really am enjoying, because it hit me about 6 months ago. I was actually doing some videos for someone. And like I said, I don't have a dog in the fight. So I like to be able to present this thing sort of from a really neutral standpoint. There's pros to everything. There's cons, like to your point, Kyle, there's pros and cons to everything. And unlike most content creators out there, they're pushing something. They're trying to sell you a trust, or they're trying to sell you a series LLC, or they're entity formation companies, or they're insurance brokers, so they want to do that. And I don't do any of it. So I don't have a dog in the fight. So I'm just going to give that information. And if there's a hole in it or potential, a lot of this, you've got to make business decisions. For example, I'll give you a quick one before we go. Do you put all your properties in one LLC, or if you've got a bunch of properties, or do you create a separate LLC for each individual property, right? That's a business decision, right? It's like, if you put everything in one LLC, you just got to recognize that all of those properties are exposed to each other, because if the LLC gets sued, everything inside the LLC is fair game. On the other hand, if you put one property in each LLC, that's probably great from an asset protection standpoint, but from a cost perspective, that might not be practical. Right. So you just got to weigh the pros and cons. And my big thing is just, as long as you understand what the risks are and what the benefits, and you can do a quality risk benefit analysis, then that's what you need to do. You need to be given the information so you can make a business decision as to whether you want to have one LLC, 10 LLCs, but just understand the risks of doing one way or the other. And as long as you're comfortable with that risk, then you do what you think is best for you or your company.
Make sure you know where the information is coming from. So, I mean, it's not uncommon for me to go talk to an attorney like you, Mauricio, and say, hey, I'm buying a rental property. And you say, hey, okay, set up the LLC in Wyoming. And I go to my accountant and I say, I'm buying a rental property. And he says, where's the rental property? And I say, North Carolina. And he says, set up your LLC in North Carolina. And so you're at odds. You've got one advisor who's trying to optimize for one thing, another advisor trying to optimize for another, and you need to make that decision and weigh the risks.
And I think we're doing jokes pretty soon here. So CPA generally stands for can't protect assets. So you don't necessarily want to hear the CPA talk about how to set up your entity structure. But yeah, entity structuring, the actual filing mechanism is very simple, but where to set up your LLC, who should own it, who should manage it, how many LLC entities should you have in it? All of those questions are where you want to have your asset protection advisor advising you on all that stuff. Because there's too many people that have come to me as syndicators like, yeah, I've created my entity. Where did you set it up? They're like, Michigan. I'm like, well, that's not the right place to set it up, or maybe the owner is the wrong. So just talk to a good asset protection attorney to get those affairs. Don't skimp on that, because at the long run, it actually costs you more, because you end up having to close down LLCs and create the ones in the correct states.
Fair enough. We got to wrap this up if I have time for my top 10.
Yeah, I got to go, but it was good seeing you guys. And
all right, I know
not going.
I was thinking about skipping the top 10, but
yes, I love that idea. What prevented you?
You know what, Mauricio? Just for you, I'm going to do a top 5, and I'm going to do the top 5 reasons to dislike Mauricio. Then.
Oh, I love that one. I can give you 25 of them.
Oh no, I'll just do the top 5. So number 1, he's from California.
That is the number 1.
Number 2, his name is difficult to say.
I can't grow a beard. Look at that. That's like a baby's butt right there. That's like a baby's butt right here.
Well, no, I'm just thinking why Americans would not have a reason, if they want to look for a reason to dislike you. So obviously another reason to dislike you for any American would be just that you're an immigrant.
It's not. Yeah, it says the Canadian.
Well, I'm not saying people can't dislike me for that either, but at least my name's easy to pronounce.
Where did this all come from?
I'm making it up on the spot right now.
I'm enjoying it. Continue. Let him cook.
Number 4, he spends too much time on his hair. Just makes us all look bad.
I swear to God, I spend way less time than all of you combined, but that's all right.
All right, I know you diet to get that perfect color.
I definitely spend less time than AJ's beard. I know that. I spend less time on my hair.
And then number 5 is obviously he's a lawyer. Number 6 bonus is he doesn't like top 10 lists. Who doesn't like top 10 lists? Everyone likes top 10 lists.
Drop a comment if you want him to do me a favor. Just drop a comment and say, hey, do something different. Like maybe we should tell jokes. Jay, why don't you tell a joke? Because we promised the audience that we would tell a joke, and they're probably looking forward to that more than top 10.
I'm telling a joke. We're not waiting until the very end.
Oh, I'm sorry. Maybe I jumped the gun.
This is the end.
This is the very end. It's all you, Jay.
This is reason number 7 that Mauricio takes over the hosting responsibilities. That's number 7, to hate Mauricio.
Hey, go for it, buddy. You can do it next week, because I'm going to be doing this the day I get back from. I'm going to roll back from my flight at 5 p.m. and do this at 7. So if you want to take hosting next week, go for it.
Yeah, you're gonna have to prepare for a topic then.
You got to prepare for all of them.
So no game today. We're done here. Like,
go for it.
Joke.
Okay. So I need to do my disclaimer, because it's not a clean joke. So anybody that might get offended by a minor dirty word, so disclaimer. If you have any kids, tell them to do earmuffs.
Earmuffs.
The suspense you're creating here.
And I'm not the best joke teller in the world, so bear with me. But I'll give it a try. You guys have to go next week. Okay, it's a little Johnny joke. You done, Mauricio? Because I won't tell the joke, and everybody will blame you.
Today, Junior.
Okay. So little Johnny goes into class. The teacher says, "Okay, class. Today, we're going to work on our alphabet. We're going to go through the alphabet. We're going to give a letter. I'm going to call on somebody. You're going to give us a word that starts with that letter, and then you're going to use it in a sentence." The teacher says, "Okay, let's do the letter A." And little Johnny raises his hand. He's really excited. Ooh! And the teacher knows, oh no, little Johnny's got a dirty mind. I can't call on little Johnny for A because he'll say ass or something like that. So she calls on Mary, and Mary says, A. Apple. My mom packed me an apple for lunch today. And the teacher says, oh, very good, Mary. Okay, let's go to B. Kyle, I already see you with that look. Get that look off your face. So the teacher says, let's go to B. And little Johnny's like, "Oh!" And the teacher's like, "Nah, I can't call on Johnny for B. He's going to say bitch or something like that." So she calls on Jake, and Jake says, "B, boy, I am a boy." The teacher says, "Okay, that's great." She says, "Okay, letter C." Johnny's like, "Oh!" She's like, "No way I'm calling on him for C." And then letter D. "Oh, no way I'm calling." And she goes through the entire alphabet. Finally, she gets to the letter U, and she says, "Okay, I need somebody to give me a word that starts with the letter U and then use it in a sentence." And little Johnny's like, "Oh, call on me, call on me, call on me." And the teacher's sitting there thinking, "Well, I can't think of any words that are that bad that start with the letter U." "Okay, Johnny, give me a word that starts with the letter U." And Johnny says, "U, urinate." Teacher goes, "Okay, that wasn't too bad. Okay, Johnny, use it in a sentence." And Johnny says, "Urinate, but if your tits were a little bigger, you'd be a 10.
Oh, shit.
There's quite a few versions of that alphabet one. You could end that a lot. I've heard the one with the R where she's like, oh, the teacher's like, I can't think of anything with an R, and he goes, R is for rats, big fucking rats with 12-inch cocks. All right, let's wrap this up. I got to get on a cruise. Actually, I've never been on a cruise.
You've never been on a cruise?
Here's a tip: eat a lot.
You think of my life. I grew up in Canada with 2 school teachers as parents. And so like every time, like at the end of the school year, if we were going on vacation, we just went to the lake, like the beach. And like, we didn't go all the way down to a different country to go on a cruise. So, and by the time I went off and started making some money and I could do my own, I met my wife and she gets seasick. So we're braving it now for the kids. We're going to get her one of the patches, the patch on the back and for back of your ear and some Dramamine, and we're going to try and brave it.
Is it a Disney cruise?
No, it's like just a carnival one, but it seems pretty kid friendly. Like they have like a kids club and
Yeah, they have all these carnival clubs. They always have activities for kids.
yeah. I just found out actually TSA pre-check. I could bring my kids too, so I'm pretty excited about that. You guys got TSA pre-check?
Yeah, can you bring your kids automatically, or
Yeah.
what about your spouse?
No, so Ashley already has it too. Obviously, she travels a lot.
Yeah, so that doesn't work because I'm like, hey, Heidi, go stand in the back of the line while me and the kids go through TSA.
She might go for that, not having to deal with the kids. So I don't know if we should give Mauricio a plug because we basically did a whole segment plug. But so we'll start with AJ down there. You got a plug for us?
Oh man, yeah, I do. Self-storage income podcast. We are getting close to a major mile marker. So any of you that are interested in self-storage, go check it out. Self-storage income.
What's the marker?
So we're going to launch the second book, which will be exactly now 4 years, almost to the date of the first one. So we're hoping to launch it all at the same time or at the exact same time, and should be good. And I'm trying to time it right at the 200th episode or something like that. So I'm hoping it converges to make it work. It'd be cool, but we'll see.
Awesome. Jay, what do you got for us?
I'm going to pitch Apartment Addicts tonight. So that is Ashley and my mentorship coaching program for anybody that wants to learn how to do multifamily investing and make tons of money. You can go to join AA for apartmentaddicts.com, joinaa.com.
And if you start buying apartments, you get the benefit of working with Mauricio.
Yeah, you get to work with me, Kyle, Mauricio, Ashley. And while we don't really work with AJ, we do lots of phone calls with him. So you get to hang out with AJ occasionally too.
That's right.
And you don't do much with me. I don't really work that hard. Mauricio, you got something else for us other than your book?
I got an amazing book to plug. Real Estate by the Numbers by Jay Scott is an amazing book that everybody should go pick up and read. And if you've got some money left over, Legal Strategies for Everyone, where we talk a lot about asset protection, estate planning, privacy, a bunch of other things. So things not to do. Check it out, legalstrategies.com. I'm sorry, legalstrategiesforeveryone.com or Amazon or Barnes & Nobles or Target or wherever you like to get your books.
I don't believe you with Target.
Oh, it's on at least on the online version. I don't know if it's in brick and mortar, but it's definitely on Target.
Yeah, it might be. It might be online, but I think in Target, I think it's like they're all religious books in there. I think.
This is a very religious book. I mean, I don't know. This is a legit, like, this is, my buddy Ken McElroy. It's his publishing company. We're going through Ingram Publishing. And so they've got connections everywhere.
Jay just went to the bookstore BYU. That's where he looked at.
Nice. Good job.
All right. Let's put our listeners out of their misery.
I got to plug my wife again, Badass Investor. Make sure to follow her this week. Maybe you'll check us out on our cruise, see what we're up to. Snap some pics of one of us.
How are you how's the plugging going to be going on the cruise ship? That's going to be a tough one.
It is going to be tough. It's a small cabin with 2 kids.
She'll go to her boyfriend's cabin. It'll be fine.
Babysitting services. That's why we picked this cruise. All right. I have had my drink has been gone for quite a while. I got to go hit the head. I got to go finish up packing. So, boys, I will see you next Tuesday.
See ya.
See ya.
Thanks, guys.